Okay. What is going on, guys? Welcome to Stock Talk with Nico Criticos. Today, we're going to do some stock analysis for Intuit because they just reported earnings. The stock is down a little bit after hours, but it's basically at the same price it was at the beginning of the day. As you can see, I have a quite large position for me in this stock, and that is about 12 shares at $515 a share. I am down 27%. But I still think this stock is going to have the next couple years of pretty solid growth, and I think this stock is going to go back to six or $700. So let's get into their earnings report. I mean, the weird thing is the report was not bad, and so that's why I don't know why the stock is down. I honestly think the stock will go up in the coming weeks and coming months, but they grew revenue 17%. All their different segments are pretty much doing really good. Increased GAAP operating income to 855 million, up 44%. A lot of these numbers are up huge amounts, like 30 to 50%, right? I always pay attention to GAAP more than non-GAAP, but GAAP diluted earnings per share up 49%. GAAP operating income up 44%. What else do we have here? They definitely talked about AI and stuff. That's because that's what everybody cares about. I don't think AI is going to take over this business. Worst case scenario, I think it just maybe hurts their pricing power a little bit. Maybe they can't charge as much or something. But let me give you two pieces of information to get a better perspective. For one, the idea that the government's going to give free software to do your taxes, I don't think that's going to happen. I mean, I think they tried it and they took it away. And then there's other websites that look like they're free, but they're actually not free once you get to the end. The other piece of info was me and my friend who use QuickBooks and some of their software for our business. He said that when he uses the AI on QuickBooks, that it actually makes mistakes. So that's another thing to consider. Not the best thing. I mean, that's one opinion, but still, it's something to consider depending on what other people think about it too. But the bottom line is their numbers are not bad, and like you look at the past couple of years, like all their metrics are solid. Revenue is solid. Net income 4.3 billion. That was the past quarter, but everything is trending in the right direction. Free cash flow, up to $7 billion now. The cash to debt is not great. They have a lot more debt than cash, which is not good. But they're increasing the dividend. The share count is not really doing much. But now here's the really interesting one that makes me really bullish. Look at these last couple of years. Here's the past 5 years for Intuit's price to earnings. We are by far the cheapest it's been in over 5 years. This stock normally trades at around 60 times earnings. Right now, we're trading at 25. Look at this one. Free cash flow yield normally trades 2 to 3%. Right now, we're all the way up to 6.5%. Almost 7. We're at 7%. Price to sales, same thing. It's the same thing with all these charts. Let's zoom in on this free cash flow yield even more. Okay, so we were at 6.5%. Now we're getting closer to 6%. So the valuation is super cheap. I just think this is a really good opportunity to make a position in this. I don't think this company is just totally decimated and has erased the past 5 6 years of value of the stock just because of these new LLMs that can do a cheap replica of what these professional companies offer. Consumer revenue up 1.5 billion, was up 15% in the quarter. Credit Karma 23% growth. TurboTax 12%. In the second quarter, the company reported a total cash and investment balance of 3 billion and 6.2 in debt. That's not the best thing. I don't love that, but it is what it is. Repurchased 960 million of stock. That's a little bit. I mean, that's less than 1%, so it's really not that big of a thing. And they still have 3.5 billion left to go. Okay, that's great. They pay a dividend. They have so here's their guidance, which I think is why people were bearish. I guess why they were selling it was because of this guidance. Revenue of around $21 billion. Let's see what they're where were they at? Yeah, so I mean that's solid. That's solid growth. I mean they last year they did 20 billion and they're going up to 20, they're growing 12 13%. GAAP operating income up 18%. Non-GAAP, I don't care as much. GAAP diluted earnings up 14%. What else do we have here? And then here is okay, so let's see. For the third quarter of fiscal year 2026, which is actually I hate how they do their calendar. I hate how they do their calendar and I hate their numbers from gap to non-gap because it skews things so much and it's very hard to value the stock when the numbers are quite different. Like in this case, this one's not terribly bad, but it's still this totally throws off your valuations and your calculations. Gap diluted EPS 1050 to 1060, non-gap 1240 to 1250. That makes it way harder to value the company. So the bottom line is the company is still growing. So far, any threat of AI competition is just speculation and I mean, I think that AI is going to be a powerful technology, like I said in the past many times, but it does not mean that it's going to replace these companies. And I think that one of the big things these companies have that the AI is not going to necessarily have is data. These companies have decades of data on millions and millions of people. And when I say these companies, I'm talking about Intuit, Salesforce, Oracle, ServiceNow, Adobe, stocks like that. Because these are all the software stocks that have been beaten down the last couple of weeks. But that's basically the way I see it. They have data that these AIs don't have. The other thing is Intuit is also partnered with OpenAI and with Claude. So it's like it just, that doesn't really help the narrative of those companies are going to take over and eradicate Intuit. That doesn't fit that narrative because they're working together. Intuit is using their technology and their AI technology to make their software better. So I see that as a positive. I see that as a positive for both companies. That's the other thing. Not only does a company like this have the data, they have the brand, they have the outreach, they have the marketing, they already have the customer base, right? Millions and millions and millions of people already know about Intuit and their brands. Okay. So that's the other thing. There's just I don't know. You're not going to know 100% until we wait another year or 2 years and we see what actually plays out. It's just incredibly unrealistic to think that AI is going to replace a company like this. And like I said in one of my last videos, I said that 5 years ago, when everybody was saying that cryptocurrency and the metaverse was going to be this huge disruptive technology and it was going to take over stuff and replace the financial institutions and smart contracts and real estate and all this stuff, that none of that happened. None of that happened. Crypto's in the same exact place it was 5 years ago. And it doesn't mean that crypto is going to become irrelevant. It doesn't mean it won't keep growing in the future, but it means that it was greatly exaggerated and it doesn't you're not going to eradicate $1 trillion industry or $100 billion company just because ChatGPT can or Claude can barely replicate what these companies offer. So that's kind of the way I see it. I think this is still a great buy anywhere around $400 a share. I think it's a great buy. But that is all for today. Thank you for watching, and I will see you in the next video.